Welcome to economictimes.com. I'm your host, Pallavi. If you look at the past few years, there has been a consistent increase among investors to invest in equity markets and explore other asset classes. Equity markets is everyone's darling till the time the bulls are there. But a slight hint of a correction, there is confusion and nervousness. In today's session, should asset allocation change during market volatility? We will be addressing all these concerns and providing you solutions for the same. I'm happy to be joined by some of the top experts. Let me introduce the audiences to our experts. Our first panelist today is Kaushik Bellapurkar, Director, Fund Research, Morningstar India. Morningstar is an investment research firm that complies and analyzes fund, stock, and general market data. I'm happy to be joined by Chirag Mehta, Senior Fund Manager, Alternate Investments, Quantum AMC. Chirag is ranked as the fourth best fund manager in the world under the age of 40 by CityWire in 2017. Chirag Mehta has more than 18 years of experience in managing commodities. He also specializes in the field of alternate investment strategies. He currently manages 5 funds, largely in the field of alternate investments that include both the Quantum Gold Fund, a multi-asset fund of funds, and an equity fund of funds, and the ESG fund. I'm also being joined by Anup Bansal, Chief Investment Officer, Scriptbox. At Scriptbox, Anup is responsible for creating investment solutions and helping customers reach their life goals through prudent financial planning, financial awareness, and wealth management. I welcome all of you on the panel.
Thank you very much.
Thanks, Pallavi.
So let me start with Kaushik first. Equity investments is for the long term, as we know. But volatility comes and that tends to make investors lose the confidence, make them confused and nervous about their exposure to different asset classes. So how do they get the formula right? What is your say?
Sure, Pallavi, and thanks for having me on the conversation, and hello to my fellow panelists. So I think you've asked a very pertinent question, especially in these times where we've seen markets having run up and then seeing some bit of a correction that's happened in the recent past. And I think this is something which is par for the course, and investors really need to think about it from a very, very strategic top level view about how do I before thinking about asset classes, you have to really think about what am I trying to achieve, right? So through my investing portfolio, what are my goals, which will really define the time horizon, the risk I can take. And like you spoke about asset allocation, really that helps you allocate across asset classes, because equities, we all know, are great long-term asset class, but it will be riddled with short-term volatility like we've seen in the past. And you need other asset classes to pack that in the portfolio, depending really on your own mix that is driven by your investment goals and the risk framework that you're looking to. And I think every investor needs to do that exercise first before thinking about what sort of funds to buy, what asset classes to buy. Really pin down that okay, these are the goals, be it short term, long term, could be over the next 6 months to the next 30 years, and then decide and allocate across asset classes. I think that's very, very crucial. Equities will obviously be a healthy component of it, depending on where your risk return profile lies. But yes, you need to do that exercise first before you can actually look at what allocation you should invest in a class like equities.
All right. So Chirag, my next question is to you. Diversification plays key role in financial planning. So according to you, is there a thumb rule for diversification to achieve financial goals in the long term as we speak?
Yeah, diversification really helps you to balance out the risk and return that you're looking for, so that you achieve adequate returns, at the same time minimizing the risk or increasing the probability to get to that return that you're looking for. So in a way, I mean, investors always looking for, is there a magic formula to it? Yes, there is something that's kind of time tested that has really worked. But before I come to that, I mean, investors know that to earn that higher return, they need to take a higher risk. But the flip side of taking higher risk is not necessarily higher return. That investors need to understand more clearly. So it's not that if you taken a higher return, it could well be you are well short of money to reach your goal, so you have lost a lot of money. So having said that, there is a formula, there is a thumb rule or something that we have seen work across cycles. It's called 12-20-80. So which means that 12 months of safe money Markets can have volatility, markets have periods of correction, eventually they will bounce back, but you need to tide through those times. And that 12 months of safe money will help you in case you have job losses, you have an emergency, you have loss on your business, etc. During times of COVID, we saw businesses got shut, people got laid off. So you need to have that emergency corpus or a kitty kept absolutely safe, be it in a bank fixed deposit or be it in a liquid fund that's absolutely safe, doesn't take credit risk, etc. So you need to be very, very safe with that money. Coming to the other part, whatever money is left after 12 months is 12 months of expenses of your kitty that you have. So if your expenses is say 50,000 rupees, so that's 6 lakh of rupees that you need to keep aside, that's absolutely safe. Moving on, rest of the money that you have needs to be split 80-20. 80 into equities and 20 into gold. Gold is one of the best known diversifiers available for an Indian investor. Time and again, when Indian equities have lost ground, gold has done well. It has supported you during times of distress in equity markets, be it global financial crisis, be it the COVID crisis. Last year, 2020, was the year when equities saw a sharp drop because of COVID, and gold was one of the best performing asset class out there. So it may not give you regular returns, but it will make it count when you really need it. So gold is 20% that adds to stability in your portfolio, and 80% should be in equities. And equities should be diversified across different styles of investing. It shouldn't be that you just like few stocks, you kind of be in few stocks. I think fund route is much efficient, much better for an investor. And within that, there are different styles of investing. So you need to split across different styles of management, different fund managers that will give you access to those different styles. And that diversification within that asset class, which is the bulk of your money, is very, very important. So that 12, 20, 80, I think is that the thumb rule or the magic formula that we have seen it work across time frames.
Sure. We'll talk in detail about this magic formula, but let me go to Anup now, especially if you're talking of mutual fund investors. So tell us, Anup, should a person or an individual who has a diversified portfolio in equity and gold and other asset classes, should volatile markets really affect their asset allocation or their financial planning? What do you think?
Thanks, Pallavi. Thanks, and I'm really delighted to be part of this panel along with Kaustubh and Chirag. A very good question, actually, and especially when markets will be volatile, right? Earlier, Kaustubh was mentioning about asset allocation and how volatility will affect or should affect the asset allocation. But actually, what would happen is that whenever you are doing asset allocation, it is very important for investors to understand the characteristics of each asset class. When you understand the characteristics of those asset classes, then you know that volatility would be there in certain asset classes like equity, and you would be in a much better, I would say, mindset to follow your asset allocation. Second thing is that objectives that Kaustubh talked about. It is important that investors always stick to those objectives. So when you have those objectives in mind, you have done your asset allocation with equity, debt, and gold, and your portfolio keeps changing or keeps getting affected with the volatile markets, maybe the equity side. But just the fact that you have diversified portfolio of equity, debt, and gold would mean that the market volatility would not affect your portfolio as much as, let's say, just 100% equity portfolio. So that's number one. Number two, since you have allocated your portfolio for the long term, and the asset allocation is always for the long term, the short-term volatility should not affect that asset allocation. So it's not like today, because equity is doing well, I should have more in equity, and then tomorrow I should kind of bring it down because I feel that markets may turn down. So that kind of timing, trying to time the market, has never worked well with any investor. So it's best that you keep the asset allocation, and automatically, if you're doing rebalancing, what would happen is that you would take money out of certain asset classes because they've appreciated quite much, like equity. So automatically there will be the rebalancing exercise will move money from equity to debt and to gold. So for example, gold has not done very well in 2021, but it did very well in 2020. So now maybe because equity has done well, automatically money moves from equity to gold. So that rebalancing exercise makes sure that you are you are kind of getting out of a more expensive, or so as to say more expensive asset classes, getting into underappreciated asset classes, and in the long term you maintain that asset allocation. So no, the volatile markets should not affect your asset allocation, but what you should do is you should keep rebalancing to ensure that you maintain that balance between equity, debt, and gold, so that you automatically move money from more the classes, asset classes which have appreciated significantly, and move it to the class asset may not have in that period.
Right. In fact, you use the term rebalancing quite many times in the conversation. So I want to take a input from Kaustubh. When we're talking about rebalancing, or say monitoring of our portfolio, what are the factors that play a key role in your opinion, Kaustubh?
Sure. And I think, Anu touched upon some very, very crucial points about, you build your portfolio, you stick with the allocation, and as, asset prices move, in different directions, the asset class that is, a little more expensive, you would look to sell down on a bit of that. And, I'll give you an example why that's important. If there's an investor who is sitting with a equity heavy portfolio, and, maybe he was an 80-20 investor, but because of the run up that happened in the markets, prior to the 2020 crash, it's possible that the investors 80% would maybe become 90%, to equity and 10% of fixed income. Now, the point is, at that point of time, automatically you should have some triggers in place as an investor, maybe with your advisor's guidance, that you bring that down to a level that you think is, either you bring it down to 80, or you could even, some people will play it more tactically, saying that equities are slightly expensive. Let me bring it down below my what we call strategic allocation, maybe from 80 down to 75. But the point is, you will still maintain an equity heavy portfolio if that's your overall allocation, right? It's not like you want to go from 80 to 0. That's never the way rebalancing would work. You would always rebalance either down to your strategic level, or maybe tactically take it down by a few percentage points. I think that is the thing that needs to be kept in mind for any asset class. Right. And Chirag, I think, touched upon another important point about gold. We also think that gold is a great risk diversifier, but the problem with which a lot of investors make is they come in very late to gold. So you should be holding gold at all points of time in your portfolio, exactly what Chirag was alluding to, rather than trying to get in. So what we've seen is that investors shunned gold for the longest time when it was doing quite poorly. And the moment you had this run up in 2020, people started buying back into gold funds. Now, come with the expectation that the way it's underperformed in 2021, which Anup was alluding to, it could do so, at different points of time, like we've seen in history. But the point is, you have to stick to your thesis and, keep rebalancing your portfolio within a confine, rather than trying to make it 0 or 1. It's never a 0 or 1 game. It's always about modulating exposure, where you see pockets of overvaluation or undervaluation, and accordingly moving your exposure. I think that's the basic principle investors should, really keep in mind when they look to move. And I want to just highlight that, especially from an equity perspective, through another example of a study that we did. The old adage is, it goes that time in the market is more important than timing the market.
That's
yeah.
right.
Let me prove why that's so important through a very simple example. So we ran the study, for the broader indices and mutual funds for the last 10 years. And we compared the monthly returns of the index versus cash. So just assume cash, say, as a liquid fund. So that's 10 years, monthly returns. That means 120 data points, right? And it did a simple exercise of saying that, okay, we know over the 10 years, equities have significantly outperformed liquid funds. That's great. But when you break it down, and you could do it monthly, you could do it weekly or daily, but what the data shows you that only a small proportion, so the good performing months or the good performing time periods are very few. And in this case, about only 8 out of 120 months actually contributed to the entire outperformance, right? So if you were not invested in the market in those 8 months, like I said, 0-1, it's never 0-1. If you as an investor were aggressively out of the markets in those 8 months where they did really well versus cash, you would have actually underperformed cash, right? So while over a 10-year period, the returns have been great, they tend to be lumpy. And that's what you need to be prepared for as an investor. Those periods can come at any point of time, but you need to be ready. Your portfolio needs to be ready to benefit from that. So I think that's, the basic principles you should keep in mind as an asset allocation guide for your portfolio.
Right. In fact, what you mentioned for gold, that's quite applicable to equity as well. That when there's a run up, everyone is interested to take exposure into that asset class. But as it goes down the hill, so the entire thinking changes. So it's very important to have a rule and a strategy in place. I want to go back to Chirag here. You talked about the 12, 20, 80 asset allocation rule. So could you help us understand how does this thumb rule or this particular strategy or magic formula, as you mentioned, help during market downside?
Yeah, so time and again, we have seen market corrections. Some were predictable, some were not predictable. Uncertainty can come in from anywhere. You need to be prepared for it, right? COVID, no one predicted, but it kind of came out of nowhere and surprised everyone, and markets kind of tumbled. So having said that, the 20% allocation to gold is what kind of saves the boat at that point in time. Given that, 2008, if you had investments in equities, they were down about 55% and gold was up 31% in Indian rupees. So that really helped you. That 20% really helped you. If you had a financial goal that was maturing in, or you had to pay for in 2008, and you were heavily invested in equities, you would have had to sell your equities at 50% negative returns, and that would have been a big loss to you. So if you had gold in their portfolio wouldn't have suffered so much at that point in time, and you could use that asset, which is doing well, to kind of pay for your financial goal that you were earmarked for. So it has really worked well in each of the market kind of downsides. And if you look at overall longer term period, the returns are not significantly lower. They are lower given that you are well diversified, you're taking care of your risk, and also during the volatile times, it has helped to escape through. But overall returns are only a tad lower. But if you look at the risk statistics, like the volatility, like the drawdowns, they are very, very much lower than what you would have with a pure equity portfolio. So say, for example, over last 10 years, the biggest fall that we have seen is during the March 2020 fall. And equities were down nearly 35-40%. That's the biggest drawdown that we saw. And if you had a 12, 20, 80 portfolio, your portfolio maybe would have been down nearly about 20% or less than 20%, given that you had 12 months of money that was kept safe. And also you had gold in your portfolio, which did well during that time. So we have seen time and again, this 12, 80, 20 has delivered in terms of getting you closer to your financial goals, because the long-term returns are a little lower than equities, but still very, very reasonably good. That would help you achieve your financial goal. At the same time, the risk that you're taking is significantly lower. And even in equity bucket, where we talk about diversified exposure to diversified styles, we have seen sometimes value not doing well, sometimes we have seen growth not doing well. So when you are that 80 is diversified across different styles of management, you also lower that risk of not having your equity performing well because one of your styles is not doing well. So that diversification also helps you inch closer to the returns that you're expecting for your financial goals.
Right, absolutely. So coming back to you, Anup, for mutual fund investors particularly, according to you, what are the possible ways to mitigate the risk in terms of their routes that they choose or styles that they choose? How do they optimize the returns, which possibly they can earn during a market downside?
Very good question, Pallavi, and I'll change it a little bit. Whenever you're trying to optimize or trying to kind of maximize return or trying to kind of achieve returns, there will always be this risk element that will be forgotten. Okay. Mm-hmm. So I think investors should always focus on making sure that they manage the risk rather than trying to kind of focus on returns. Important thing, again, I'll just draw your attention to the goals. And I think Chirag talked about 12, 80-20 kind of scheme. Now, why is it so? Is because you want to maintain some liquidity to ensure that you do not have to dip into your investments because you need the money, right? Because ultimately we are creating a corpus because we want to use the money for certain purposes. And if I have to sell my investments because equity market is down right now and I need the money, that's the problem. So when you maintain an adequate corpus for your expenses, like Chirag said, for 12 months, then you do not have to dip into your investments just because the market went down, right? So one of the strategies for making sure that you do not have to dip into your investments is to ensure that the liquidity is there. And there are only three reasons that why you would want to kind of get out of the market or sell something is because you need the money. So if you have your adequate corpus for or liquidity taken care of, then you don't need to do that. And you keep doing asset allocation rebalance, which Costa gave wonderful examples actually. And here, I just want to mention about diversification, right? So what is diversification? Diversification is done because all asset classes do not move in the same direction at the same time. Now, when we talk about gold and between gold and equity, and Chirag was mentioning about the returns, since 97, if I look at the returns for equity, the index has given around 14% return, and gold has given actually 11% return. But if you see the correlation between the two, it's negative. So as equities would move, when equities are going up, gold tends to not go up at that moment because they are negatively correlated, and and vice versa, right? So what happens is the diversification, because of the lower correlation, it helps to ensure that the volatility in your portfolio is down, right? And so when the market is down, and if you have followed asset allocation, what would happen is that your portfolio will still show that stability. And if you have aligned to your objectives, you do not have to dip into your investment. So second thing I was talking about, why would you need to kind of exit asset classes? Because you want to do an asset allocation rebalance. And third thing is, now we have talked about asset allocation, but also the underlying instruments. So for example, mutual funds. So you asked the question about how do I optimize return during market downside, and give it time for it to kind of perform. So it's not like you just invest the money and in 1 year's time, you will again see the investment doing well. It can take some time for the strategy to play out. So make sure that you keep reviewing the fundamental characteristics of the underlying instruments, whether it's mutual fund or any other asset class for that matter. And then take action only if you feel that the fundamental characteristic of that instrument has changed. So that will be the third reason that why you would want to exit. So those would be some of the strategies that people or the investors can use to manage their portfolio, not only in market downside, whether it's upside, downside, but stay with the asset allocation. And also one important thing is do not over diversify. So sometimes people like investors think that by just having like 30 stocks, 40 stocks, or 20 mutual funds, my portfolio will be very stable. But then what happens is you also get affected by the over diversification, and the benefits of any individual mutual fund doing well or any individual stock doing well may be limited in your portfolio.
Right, right. In fact, Kaustav, over diversification, another keyword I got from Anu, that's another neglected concern. I mean, it's a very important, crucial role in your financial planning, somehow gets neglected. So I want to ask, Kaustav, do you think any kind of downside or correction in stock markets, it is actually an opportunity for increasing exposure in equity segment? And when it comes to over diversification, do you have any perspective as to what should be the extent? Or will it also depend on other factors which we discussed earlier?
Sure. So let me address each of these questions individually. So the first part about really thinking about equity allocations, right? I mean, if there's been a market downturn, obviously the value of your equity portfolio has fallen. The first thing I would think to do as an investor or as an advisor to take that back up to probably strategic levels and see where valuations are, and maybe even go beyond my strategic level, right? So, I mean, just to give you an example, like I use the example of, if you are an 80-20 investor, 18 equities, and, during a market crash, it's probably, say the March crash, it came down to 60% in equities. You would want to take that back up, rebalance and take that back up to 80%, not go overboard and take that up, to 100%, right? Because even if equities are cheap, there is a reason why you've built an asset allocation. You would want to, kind of sit in that framework, right? Like I said, depending on relative valuation, you might want to take that 80 to 85, maybe 88, but typically you will never do a 0-1 principle like I was talking about. So it is a good thing to buy in market corrections, but Also think about, where your allocation, which is, like I said, derived by your goals, where does that lie? That's really the holy grail when it comes to thinking about the way you modulate your portfolio, right?
Right.
The second question, in terms of diversification, and I think, Anup and Chirag touched upon some very important points, that most investors, either don't think about asset allocation at all. It's always a product-driven approach. They just like this fund, this fund's done great, or this asset class looks good and would buy that. That's not scientific. We've been talking about, first build your asset allocation. Think about the sub-asset categories that you would want to get into, depending on your risk return profile again, and that's very important. If you're an equity investor, it's not necessarily that you have to have a small cap exposure. It's possible that you have a slightly shorter time horizon. It could be driven largely by, say, large and mid cap sort of strategies. But you need to build in, elements of diversification within that. And I think Chirag touched upon a very other interesting point is diversification in styles. Because this is something which investors tend to miss, is that, you think you're buying a couple of funds, but if the style of that fund is very similar, right, then the holdings would tend to move in a very similar fashion. I'm going to give you an example. A lot of investors were very gung-ho on the growth style of investing, which did really well in 2018, 19, in the early half of 20. And a lot of money went into those funds. A lot of investors got over-diversified there, ignored the value style, right? And we've seen value having played the catch-up game over the last 1 year. And I think you need to blend that, because you don't know when the tide is going to turn for a particular style. You can't time it, like you can't time the market. You need to diversify, but diversify scientifically when you're trying to buy, rather than just, like Anup was alluding to, just buy 20 funds or 30, 40 stocks and you think that you've diversified. I think you need to look at a little bit of the style analysis, the factors in terms of capitalization or the kinds of funds that you would buy to do a more scientific diversification when you build a portfolio.
Right, absolutely. So we've touched upon equity and how they've performed, and we also spoke about gold, but I also want to bring my panelists' attention to debt funds. And if we look at the current scenario, there have been concerns about inflation, and RBI also expected to, raise the rates in financial year 23. Chirag, if you want to answer this one, with debt funds and the kind of performances we've seen in current times, because of course that is more short term, what does it actually mean for mutual fund investors?
Yes, so within that, whenever investors invest in debt, they have to understand that they are not completely risk-free. There is also an element that you could have negative returns from your debt fund. So you need to be ready for that. It's not a replacement for your fixed deposits, and there could be an element of loss. Having said that, in the current scenario where we are looking at the interest rate trajectory be moving up, inflation be running hot globally and in India, within that, there could be possibility of yields moving higher, and therefore your long bond exposure may be, there could be losses there, there could be capital losses there. So at this juncture, we think that liquid funds will be a better way to play the bond cycle, given that, your every reinvestment into liquid funds, or the liquid funds making reinvestments, will be at a higher yield. And therefore, it would be a better way to play the current trajectory of rising yields that we could be seeing. So rather than having a long duration exposure, I think liquid funds would be a better way to play the bond cycle right now.
Sure. Anup, you want to add something on debt funds? What's your take?
Yeah, actually, like Chirag mentioned, because of the inflation concerns, it's likely that the yields will move up. In fact, if you see in November, the yields were somewhere in the range of, for the 10-year treasury or government bonds, the yield was somewhere in the range of 6.4%. And right after the budget, it moved to 6.95. And now it's come down to around 6.7 as of yesterday or today, right? So the yields have been moving up, though they've kind of softened over the last two days, probably because RBI decided this time not to increase the rates. But eventually in this year, we expect that the rates may increase because of the inflation concerns. And it's better to stay on the shorter end of the curve, which means that the impact of the interest rate changes would be limited, because the duration is limited in the of those mutual funds. So like Chirag mentioned, liquid funds would be a good category, ultra short money market kind of. So stay maybe a year a long duration kind of, or maybe a little more, but not like you don't want to stay on the 5-6 year duration cycle. Definitely not.
Okay, sure. Kaustubh, since we're move towards the conclusion of the session, also want to talk about the outlook for 2022. So if you look at the previous year and the 2020 that we spoke of, 2021 was, the year of recovery, we can say, in a manner, and growth rates got back to pre-COVID levels, and even the corporate earnings that we saw, they were showing some improvements. So what is your outlook for 2022 for all the three assets, equity, gold, and debt?
Sure. Pallavi, I think when you think about from an equity perspective, and we know, like you alluded to, that recovery is well in progress. From the corporate earnings side, we've seen the announcements of budgets around government capex, the infrastructure push, which will obviously aid a lot of money come back into the economy and really having that multiplier effect. But the one thing that's happened is valuations have obviously kind of moved up. The last year we've seen, since the March crash, valuations have steadily moved up. In 2021, obviously was no different, where we saw, the broader markets trading at, what you would call slightly stretched valuations. So I think from a long-term perspective, equities are obviously a great asset class, but from a short-term, investors can expect, I think, volatility for the year 2022 to continue. Obviously, it'll be driven by how companies continue to report good earnings growth. But it could be a little challenging in terms of volatility. But I don't think investors should be too perturbed. Like we said, stick to asset allocation, because this is typically what you would see in an equity market cycle. So I don't think so. We're definitely bullish, and continue to remain bullish on equities for the long term. But in the short term, you can expect some volatility given where valuations lie. I think from a fixed income perspective, and that's the panelists touched upon that interest rates are. Obviously with the recent RBI policy, they've still held an accommodative stance. But inflation does remain a little bit of a concern. So, interest rates will be volatile. They'll probably, with the upward pressure. So investors should look more towards the shorter end of the curve, while investing. I think that's the sort of clear trend where you'd want to stay at. And I think gold, it's more of a portfolio hedge. It's very hard to put an outlook, like I said, because it is very, very driven by market sentiment and things like that. But it should be an evergreen part of any investor's portfolio, purely from the fact that, and what Chirag was referring to, is that it can move completely contrary to equity market movements. The correlation is quite, and that's how we would play gold as a market hedge without really taking a view, because it's hard to take fundamental view necessarily on gold in that sense.
Well taken. So Chirag, like I also want to know your outlook on, for 2022 for all the assets. And also, is there a category of funds that can be, considered by investors in the current market conditions? Anything specific you want to discuss on?
Sure. Equities, we think that earnings growth is on a higher trajectory. It's improving. There is some inflationary pressure that is kind of impacting the earnings of companies. But overall, we think that, India probably is on a cusp of an economic revival, and that will continue. And earnings will be in an upcycle from here on. That could really, what we stare at is higher valuation at this point in time, but the earnings recovery can, subdue that higher valuation that we are setting on right today. So overall, I think equities could be a good place to be. And within that, as we kind of showcase that it needs to be diversified, we stick with that call. Value hasn't done well for the last few years. So probably if you look at the value versus growth dilemma, I think value could be in for a surprise. There could be upside to value stocks doing much better, like what we saw in the 2003 to 2007 cycle. Initially, the value stocks started doing really well when there was a rationality in markets. So even this time when earnings catch up, so far, if you look at from 2015 to 2020, the earnings were not really that high. Earnings growth was kind of missing from the markets. And now, since we are looking at the valuations or earnings catching up, I think value stocks may do well. And another is the bout of ESG stocks, ESG funds. I think that could be a good way to start investing in building that sustainable portfolio, which would likely do well, because we have seen sustainability as a driver of long-term returns could really help in delivering that higher return from an equity allocation. And apart from that, you need to have diversification across different styles of investing. So probably you could do it yourself, or you could use solutions like equity fund of funds, etc., to build your allocation there. Just to touch upon the gold, I think gold may remain range bound for some time. And probably when we see that, the central banks again kind of throw in the towel because of growth impact getting impacted, probably that could be a turning point when gold may start doing that. So for the next few months, there could be a range bound movement that we could see in gold. But as we see pressure on growth and central banks again taking a U-turn in terms of their tightening stance, that could bode well for gold.
Sure. Thanks for those insights. And Anup, before we close, your closing remarks and your outlook for 2022 for all the asset classes.
So, like Kaustuv and Chirag mentioned, so on the equity side, yes, long-term potential of the Indian market, great. Short term, there can be some of the, in the short term, there can be some challenges. And the reason I say that is because currently we are still on the higher side of the valuation, like the PE maybe somewhere in the range of 26, 27 keeps hovering around that. And unless, and earnings have to keep growing in order to make sure that those valuations are justified. And there's definitely a good potential. And if you see the budget also, just the fact that the capital expenditure has been increased. The budget for the capital expenditure has increased to 7.5 lakh crores. But still private expenditure has not taken off, right? Because probably still there is some kind of growth that needs to be kind of needs to happen. The demand needs to pick up. And unless that happens, you will see some kind of pressure on the earnings also. So depending on the short term, there may be some challenges on the equity side, but like we said earlier, if you stick to asset allocation, there's no problem. On the debt side, again, stay on the shorter end of the curve because of the reasons that were mentioned about inflation being a concern. And though CPI is around 4.3% or, and the projection is 4.5% in the next 1 year, but WPI has been high, right? So, and just means that the cost has not been passed on. So on the debt side, there'll still be inflation concerns. So stay on the shorter end of the curve. Gold has not performed well in 2021. 2020 did really well. Overall, it's a good hedge. And since there will be inflationary pressures, gold always tends to do well whenever there are such kind of inflationary pressures are there. Now, just to conclude, important thing is when you're creating the portfolio to keep three things in mind. One is that do you have sufficient liquidity to meet your expenses, like Chirag mentioned, for 12 months. So ideally, you should have that. Second thing is anything that you need, any goals that you need to be serviced, or any money that you need for the next 2 to 3 years. Do not, and I all the investors this, that we tend to sometimes get carried away with the market momentum, that we want to kind of invest that money also, but do not take risk. Be safe there. Invest in liquid funds, ultra short funds, or money market funds to ensure that the money is available whenever you need it.
Right.
For the asset allocation, your portfolio, you should have an outlook of more than 2 to 3 years at least. And that's where you decide which asset classes you want to stick with. Now, to give you an example, these days, startup investing is becoming kind of very attractive, right? With all the funding that is happening, everybody wants to invest in startups, but it may not be for you because of the volatility. 1 in 10 startups typically, if you see the data, is successful. And if you end up investing in 1 or 2 startups because of your limited funds, the chances of you being successful there are very, very small, right? The probability is very low. So make sure that you choose the asset classes wisely, which are relevant to your particular situation and your risk profile.
Right.
And then go and start investing in products, right? So that should be the approach that people should follow, and stay with asset allocation and rebalance.
So asset allocation is going to be key for your long-term wealth goals. Thank you so much, gentlemen, for your time and being part of this panel. We'll bring in more insights and more interesting webinars and panel discussions. Stay tuned with economictimes.com. Thank you so much.
Thank you very much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.